what we're gonna do soon is, and what kind of we went over, was a somewhat detailed due diligence of determining if a deal makes sense before you make an offer. But if there's in Fairbanks, we don't have a huge, especially right now, we don't have a huge surplus of properties on the market. So it is possible to look through every property available and analyze it thoroughly. However, depending on how many properties are on the market, you want to have some rules or tools to be able to quickly filter through properties that just make no sense as a deal. And so some of the common ones are the 1% rule that you might be familiar with. And this basically means that your monthly rent is greater than or equal to 1% of the purchase price and upfront repairs. So for this example, if the purchase price and upfront repairs cost you $100,000, you want to make sure your monthly rent is at least $1,000 a month. And that's easy. So if you $200,000, you want to make sure your monthly rent is $2,000 a month. But you have to really put that in perspective, because in certain areas, this doesn't account for the expenses that we have to pay on a monthly basis here in our local Fairbanks market. So yes, you might have monthly rent of $2,000, but this doesn't account for the extra $500 a month you're paying in utilities and other expenses. So you really want to understand what is typical for your market of the property type that you're looking for, and then try to make offers on the properties that beat that average that you're looking for. And there's the 50% rule. So this is when you're doing a quick analysis of a property, you assume that 50% of the monthly rent goes to operating expenses, which does not include your mortgage, but that includes taxes, insurance, utilities, repairs. It's all those fixed expenses we talked about, except for mortgage. And I think I've seen historically around 43-ish%, and just it's really highly dependent on the utilities here on how close you get to that 50%. These are just simple tools to help you quickly analyze if a property even makes sense to do a thorough analysis. But depending on how many properties are available, I definitely recommend doing a more thorough analysis, especially if you really like a property. You should never make an offer without doing a thorough analysis, which we'll be going over shortly. Once again, yeah, just these are just rules so that you know to do a thorough analysis. They should not be your only form of analysis. So where to go from here? First, you have to learn your market. You have to really understand the market you're trying to invest in. You have to be smarter than the other investors in your market. Maybe you're not going to be the smartest investor, but you definitely want to be knowledgeable about your market. You want to know the average rents for specific types of properties. So for 1-bedroom, 1-baths with stainless steel appliances, for 2-bedroom, 1-baths that are 1,000 square foot as part of a duplex, various things, 3-bedroom, 2-bath, single family homes, whatever. You want to have a rough idea of average rents, so that when you use Rentometer, you'll know if it makes sense or not. How realistic are those values? And there's tons of ways to do that. I mean, the easiest way that I do it is I look at Facebook or Zillow or whatever, and I look at all the properties available or several properties that are similar to the ones I'm renting out or I'm looking to acquire. And then I just compare, all right, what is literally the average of the 10 most similar properties? That's a good way to determine what the average rents are in your property. You want to learn what are average purchase prices for different types of properties, and and that obviously changes over time. So you were able to find more duplexes in the last few years between like $175,000 to $250,000 duplexes in Fairbanks over the last few years, because of this crazy appreciation we've had pretty much all over the nation, especially up here, or including up here. Purchase prices for duplexes range between, you'd be lucky to find one around 240 all the way up to like 350, 4. I mean, it really depends on the size of the property. I mean, I've seen duplexes up close to 500,000, and but purchase price is just one way to look at a property. You have to actually analyze it to understand, because that one duplex for 400,000 might rent for 3,000 aside, or well, that's not really realistic, but maybe 2,000 aside, 2,200 aside, where the $250,000 duplex only rents for 1,200 aside. So you really have to kind of understand that, all of it together. It's a holistic approach. And then what are some typical investment returns? Is it that every single property is guaranteed, you're calculating a 10% cash on cash return? So maybe 10% isn't as phenomenal as you thought. Maybe you're looking for the ones that are 15, 18, 20% cash on cash return. Or, you really want to be able to understand your market as much as possible. So first and foremost, you should learn your market. Then you want to determine your investment goals. As I mentioned, my investment goals are determined based off what I think is realistic in this local market and based off what financial goals I'm trying to hit with every property. And as I stated, I'm primarily looking for multifamily properties that get me a cash flow of over $100 a month per unit, and then at least a 10% cash on cash return when I account for all of the reserves. That's my goals. Everyone should have their own goals. You can anchor it off what I stated, but please, like, that's really important for you to understand what your goals are, and it's really dependent on what is your investment strategy, asset type you're looking to purchase. Really depends on what you're looking for. So please do that as your homework as well. Then you want to begin to analyze properties, and you want to focus on the ones that have been pre-filtered to save you time based on those rules that we discussed, the 1%, 50% rule, and that match your property criteria. If all you want to do is buy 3 bedroom, 2 bath, single family homes, there's no reason to waste your time on other investment types necessarily. If that's really what you want to buy, you want to buy something only with garage or only with this, try to develop a property criteria that you're looking for. I'm actually really flexible in what I'm looking for. I don't care if it's got a garage or not. I'm primarily looking for 2 to 4 units that have split electric meters. That's, I mean, there's obviously certain caveats to it, but I'm pretty vague in what I'm looking for because we don't have so many properties that I can't analyze all of those that hit that criteria. And I'm looking for purchase prices under 400,000 typically. I mean, that's roughly what I'm looking for. So that's how I filter it down at least a little bit. And then once you analyze properties, this is probably the most important because most people have an paralysis by analysis. They spend so much time analyzing properties, but they never actually trust their numbers and execute. And you can analyze. I'm an engineer, so all I do is run numbers and things like that. And I had a lot of paralysis by analysis. I was running numbers, and properties were hitting my metrics, but I wasn't executing. It's so important to trust your numbers and then execute. And really important when you're starting out analyzing properties, please reach out to resources, other investors who have done this before, and say, hey, can you quickly look at my analysis and see if this makes sense? Plus, there's tons of tools online. There's Bigger Pockets calculator, there's Deal Check app, there's tons of things, including the calculator that I'm going to share with you. So, just use the tools available, analyze a property, and then if it really does hit your goals, if you actually do want to invest in real estate, you have to actually execute. And that starts off with, I would recommend, if you're brand new, working with a realtor, and not just any realtor, someone who's familiar with how to look at investment properties. It's really important. As I might have mentioned earlier, Mike Garza is my realtor up here, and I love him because he and I have gone into crawl spaces together. We look at, lots of people who are buying a home are going to go look at the kitchen, the countertops, and the cabinet color or whatever. And none of that really matters for a real estate property, a real estate investment, because you can change cosmetic things. Things that matter are going to be the foundation, the crawl space. How does the mechanical room look like? How many meters does it have? Things like that. You got to know how to really look at a property as an investment. And it's really helpful if you get a realtor who understands how to do that, especially when you're starting out. So at the very least, get a realtor that'll help you do that type of analysis, or maybe not help you run the numbers, but at least help you look at properties like that. And then run your numbers and have them make offers for you that actually make sense. All right, so let's analyze a few deals. We're going to look through 2 that didn't get accepted, and that's fine. You want to make offers and understand that most of them are not going to get accepted, because your goal is to make sure the offer you're making gets you a great investment return. Sometimes that's not going to align with what the listing price is, and that's fine. You should never be discouraged about making an offer and someone not accepting it. Luckily, there's millions of properties in the US. You can keep doing it over and over again. Don't ever worry about someone telling you no, and I'll be going over that a little bit later. But we're going to go over a duplex, a triplex, and if time allows, we can actually run through a property that one of you guys has in mind. All right, so let's start with 1963 Parham McCormick. This one was available a few months ago. It was swooped up very quickly from my recollection. This one was one that had pretty good bones but needed some cosmetic upgrades. And it was a 4-bedroom, 2-bath, top-down duplex. The listing price was $225,000 with a 25% down payment, because we're using a non-owner occupied investment loan. So the standard is 25% down payment. And if you look on my chart to the right, it breaks down the total upfront costs. In this scenario, that is your down payment, the closing costs, which we've estimated at 2.5% of the purchase price, as well as the $5,000 in upfront repairs. So upfront repairs, once again, are the rent ready repairs. What do you need to do to what do you need to do um, to get the property rented out? Yeah. And then the long-term repairs in this list over here, these are not accounted for in your upfront cost. These are, you're going to need to replace the roof in within the next 5 years. You should start saving towards that 15,000. That's where your reserves are going to play a role into, but that's not going to count for your upfront costs because that's not crucial to rent out the unit. I mean, unless it's leaking water, but then you definitely need to get that done or have your inspector mark it on your inspection so that on your inspection report so then you can ask the seller for a new roof. But yeah, let's move forward with this duplex analysis. So you might objectively think $225,000, that's pretty good. We mentioned that's a pretty good price for a rental property, a duplex, but let's actually see how that plays out. So let's go through the income and expenses. So your rental income for this scenario comes from Rentometer. Sometimes the homeowner will actually list the rental amount. I actually believe that the rental amounts were listed on this listing. So that's exactly what we got. They were both 2-bedroom, 1-bath. One was upstairs, one was downstairs. The upstairs was a little nicer and was renting for $1,400. And I believe it had access to a garage, whereas the downstairs unit did not have access to a garage, was smaller, and because it's a basement, it rented for less. And then let's look at expenses. So the property taxes was pulled directly from Zillow. It's whatever it said it was recently at. That's what we did. Approximate of $80 a month for insurance. Since this is a non-owner occupied investment property that you're putting 25% down, there is zero mortgage insurance. I put in a placeholder for water, which is $150. My calculator has placeholder utility costs based on Fairbanks markets, depending on the property size. But you want to make sure you do your due diligence and ask the seller for those specific utility costs over the last couple of years and take that average and put it into your calculator. But you obviously don't necessarily do that from the very get-go. You got to be able to analyze the property before you even start that communication. Once again, heat is also a placeholder because this property was in North Pole and North Pole does not require garbage costs. That's zero. Whereas in the town of Fairbanks, you would have to pay a garbage cost. There was no common room or mechanical room or anything like that. It was included in one of the units. So there was no utility or electricity cost for you to cover. With the management fee at 10% and the reserves of 18%, let's actually look at how the analysis of that goes. All right, so here's the analysis of 1963 Parham McCormick. The rental income was $2,550. The mortgage is $830, very low because you have a pretty large down payment and you have it's not a huge purchase price. The monthly expenses, the ones you have to pay every month, are $1,021. The reserves are fairly low. It's the same percentage, but because the rents are a little lower, the reserves are lower than the original example we looked at. And the monthly cash flow is $240. That's pretty great. I mean, you're getting $120 a month in cash flow per door. That seems pretty good, but the cash on cash return is only 4.5%. So why is that the case? This seems like it might be a home run from the get-go, but the cash on cash return was only 4.5%. Well, as we recall, cash on cash return is your annual cash flow. So the 240 times 12, which is 12 or $2,880 here, divided by your upfront costs. Because there was such high upfront costs for that annual cash flow, it ends up with a fairly low cash on cash return. I'm not saying this deal isn't worth pursuing, but it might be better to make a slightly lower offer or just understand you're not going to get the highest cash on cash return for this property. Something I like to do in my analysis is I like to have the cash on cash return, which accounts for all my reserves, but I also like to know my cash on cash return next to the 4.5% if I do not have any savings. I think that's an important tool, and other investors have liked to see that in my calculators because it basically gives you a theoretical minimum and theoretical maximum return on your investment. You're never going to make more than what your reserves say unless you decrease this 13.09% cash on cash return unless you either decrease your expenses or increase your income. But realistically, when you account for all your reserves, your cash return is around 4.5%. Your realistic is going to be somewhere in the middle, somewhere around the middle. But I always account for, this is where Mike said I'm more of a conservative investor. This is where I account for that lower end of the spectrum, because I want to make sure that if I'm investing my time and my money, I'm getting a very great return. That's my goal. And this isn't where you stop, though. This is just how you analyze the property at its face value. Your offer, so every property has a price that makes it work. Maybe it's not the listing price, but it's your job to find out what is that price, and then make the offer if you want to move forward with the property. If it's lower, if they're asking for 225 and you offer 210 and they don't accept it, I mean, who cares? The worst thing they can say is no, and who cares about that? I mean, that really doesn't matter. You're going to hear, Mike knows, I've heard no, well, obviously way more times than I've heard yes. But when we get those offers accepted, it is huge, and your numbers are going to be phenomenal. And that's what you're going for. So this is another part of my calculator, which people really like. It basically shows if you ask a certain percentage below the asking price, what is the a certain percentage below the asking price, what do the returns look like? This so in this scenario, in this scenario, you're gonna have to go all the way to like around 17% below asking to get to that rough 8% cash return, or somewhere between, so maybe around 15% below. So if you want, you can make that offer for $191,250 and say, hey, this is my offer. You feel good about it. It's obviously 15% below the asking price. It's more than likely going to get rejected, especially in this current market. However, if that property sits for a few weeks or a month, your offer becomes much more promising for the seller, because they want to actually sell their property. They don't want it to sit there for too long. So at the very least, if your number is realistic and fairly reasonable, especially within 10%, I would make that offer. And I'm going to talk about some various strategies a little bit later on the next property, just kind of give you some insight into what I do to make my offers a little more competitive. But this kind of gives you an idea that there is always a price that makes sense. Once again, it might not be the listing price the seller has, but there's a price, and if it's fairly reasonable, I would go ahead and make that offer. It's not too much work, and if they accept it, then you're getting a great return. Let's move forward to the next example. So this was a triplex. It was on Parkway Street, kind of in the heart of North Pole. I can't exactly remember the number. Doesn't really matter, just the street number. But this was a 4-bedroom, 3-bath, side-by-side triplex. There was 1 2-bedroom, 1-bath unit and 2 1-bedroom, 1-bath units. It was a list price of $315,000. Once again, this is a non-owner occupied investment loan, so you're gonna need 25% down payment. There's a typo here. The total upfront cost is not $64,000. In this scenario, it's $82,000, and all the analysis moving forward will show the $82,000. There's a typo on here. In this property, the condition was turnkey. These were 100% ready to rent. They did not need any upfront repairs. They did not need any significant work at all, any cosmetic work, anything. It was ready to purchase and either maintain the tenants or have them move out and put in your own new tenants. So for this triplex, the rental income came from the listing. The actual seller said, hey, my 1-bedroom, 1-baths, they rent for $1,100 a piece, and my 2-bedroom, 1-bath rents for $1,400. The taxes were pulled from Zillow. The other expenses for the triplex were estimates. The water and sewer was an estimate for a triplex. The heat was an estimate for a triplex that I put in. Because it's North Pole, the garbage is 0, and there was no common electricity room, so that was 0. The management is auto-filled. Insurance should probably be a little higher. That was my bad. It should probably be closer to 100, 120, but it's not going to necessarily make a huge difference for this analysis. Once again, the reserves are the same. Vacancy of 8%, maintenance 5%, and CapEx of 5%. We're going to talk near the end about your analysis that you do to make an offer, and your pro forma analysis, which is what you realistically thinking you can get out of the property. For example, this property was very nice. I think the rents are very reasonable. I would assume the vacancy is going to be less than 5%. I assume this property is not going to sit vacant very long at all when it's rented. So for my pro forma, I would have a lower vacancy. But when I'm making an offer, I want to make it as realistic as possible. And as Mike said, as conservative as possible without being so conservative, I'll never make an offer. But as conservative as I feel is reasonable to make sure that if I'm investing my time and money, it's my money's working very hard for me and making me good returns. So let's go into the actual deal analysis. So the rental income was 3,600, mortgage 1162, expenses 1385, reserves 648, and cash flow was 405. So that was a little higher than we saw in the other property. And the cash flow per door is 135.01. So that's great. It hits my goal of $100 minimum per unit. And the cash on cash return in this example was close to 6%. But if you look at the without savings range, it's 6% on the low end and 15% on the high end. I would actually, that's a pretty good deal in my book. Yes, it's not automatically at the 8%. You could probably offer something a little lower, and we'll go over a little bit more creative offers than just the outright offer to hit that 8%. But I like this. I like these returns. I like the cash flow per door. I think it's worthwhile. Cash on cash return, I wish it was a little higher with the list price, but that's all right. I'm still going to make an offer that makes sense and is reasonable. And I know that worst case scenario, if I have to account for all my reserves, all my expenses as they are, I can't increase rents, I know I'm going to get 6% cash on cash return. That's a pretty good worst case scenario. And I know you can go 15% if you don't have to account for any reserves, and even higher if you can increase rents or anything like that. And I really like that it was turnkey. It was a turnkey rental. It was ready to go. There was no work to be done, you know. And there, I think there was definitely ways to increase a little bit of rent increase. They had some storage units on site. You could charge 25 bucks a month for those storage units. If you're the landlord and you're covering electricity costs, then sometimes here in winter landlords will increase the electric cost 25 to 50 bucks a month because people are plugging in their cars. I knew there were some avenues that you could get good returns here. All right, so your offer for Parkway. In this case, a listing price offer could work, but to hit your 8% cash on cash return goal, oh, we're in a little double typo there, you would need to offer around 288,000. That's around 8 to 9% below the asking price. For this property, I know that's not very realistic. I know this property is probably gonna get swooped up as is for that price. People like when they pay close to $100,000 per unit up here is what I've noticed because I understand my market. So this one's pretty close to that. So it was gonna get swooped up, and it did. It got swooped up pretty quickly. And it's up to you to determine to run the risk of losing out on the property. You can offer the listing price, you can offer over listing price, you can offer below listing price. It's really up to you, and it's your, I guess, cost to benefit analysis. That's not the accurate terminology, but really realistically, it's do you want the property more than you're willing? Are you willing to compromise a little bit on the price and your returns to get the property, or do you not want to compromise, but you have a higher likelihood of losing out on the property? Especially in this crazy competitive market, you're more likely going to lose any properties that are not at least at list price, if not higher. But there's some strategies that you can try to employ to kind of get the best of both worlds. One of them is an escalation clause. If this is something you're not familiar with, basically you make an offer that makes sense for your investment goals, but the escalation clause basically states, I will pay you $2,500 higher than the best offer up to a certain amount. So in this scenario, we offer $288,000 offer price. With an escalation clause of $2,500 over the next best offer up to, let's say, your list price or $320,000, that is kind of a way to kind of get the best of both worlds. So if no one offers, if there's zero other offers, then that's okay because they can accept a $288,000 offer or they can, reject it. But at least you're kind of getting that out there. Typically, my experience is if you're the one offering an escalation clause and someone's offering listing price, they're probably not going to go with the escalation clause. I mean, unless they really care about that $2,500, but they're probably just going to go with the property or with the offer that actually offer them listing from the get-go. So, it's all really up to you. The risk is up to you, and it really depends on, are you willing to compromise a little bit of returns to get the property, or are you fine with losing the property out if it doesn't hit your returns? It's ultimately up to you.